Conceptual framework for the financials reporting. The importance of conceptual framework. The conceptual framework is a set of theoretical principle and concept that underline the preparation presentation of financial statement. If no conceptual framework existed, then accounting standard would be produced on a haphazard basis as a particular issues and circumstance arose. The accounting standard might be inconsistent with one another and perhaps one even contradictory. So, the strong conceptual frameworks means that they are the principle in place from which the future accounting standard draws. It also acts as a reference point for the preparer for the financial statement. It also, if no accounting standard govern a particular transactions, although there will be an extremely rare, this concept text of considers the text content of the conceptual frameworks for the financials reporting in more details. So, सबसे पहले we are going to know the purpose. The purpose, there is a broad term when the purpose of the conceptual is to assist the board when developing the new IFRS preparations of the financial statement. When the new IFRS standard is applied to the particular transaction, then IFRS standard offers a choice of accounting policies. All parties were understanding and interpreting the IFRS standards. The conception is not an accounting standard. It does not override the requirement of any particular IFRS. So IFRS will always override and will be given as a first preference over the conceptual framework. So the conceptual frameworks comes with certain objectives, and the objective is to assess the objective is to provide the information to the correct and the potential investors, lender, and other characters that will enable them to make the decision about providing the economic resources of an entity. Now, when you say the accounting, the summary of the concepts, so it's talk about the measurement, definitions, elements, recognitions, quantitatives, useful informations, and then aggregations, presentation, OCI, and classifications. So when we saw the qualitative characteristics of the useful financial information, the financial characteristics pala relevant and should be the faithful presentation of an entity. So first relevance का मतलब there should be a relevance. It means make the impact of the decision made by the users of the finance. The relevance require the management to provide the materiality. An item's material, if omitting or misstating and obscuring, it could influence the economic decision of the material. So material means responsible for the decision making. Responsible for decision making. That is the and the faithful presentation means it should be the complete, natural, and free from the error. So the faithful presentation would be represent if the economic substance rather than in legal form. So we will always give the priority substance over the form. So substance will get the priority. So the reason a perfectly faithful presentation would be complete, neutral, and free from the error. The broad note is not only the fully achievable, but these qualities should be maximized. So it should be the prudence. We should always exercise the prudence. Prudence means the assets and the incomes are not overstated, liabilities are not understated. However, this does not mean that the asset should be purposefully understated and liability and purposefully overstated. Such intention or misstatements are not neutral. So it has to be neutral also. So enhancing the characters. So in addition to the two fundamental quantitatives, there are the four: comparable and timeliness, and the variability and the understanding. The comparable, the investor should be able to compare the entity information year to year from one entity's financial information with another. So it should be the comparable. The timeless, the older information is less useful, so you need to be in the very timely manners. and verify the knowledgeable user should able to agree that the particular depictions of the transaction offer a faithful presentation, and the understandable information should be presented as clearly and concise as possible. The cost consistent. Producing financials take the times and the cost and money. So when developing the IFRS standard, the board may assess whether the benefits of reporting the particular information through the cost involved providing so consistent. There is an example. So the cost constant example, IFRS 16 lease, which replaces the IS 17 lease, radically changes lease accounting by requiring all lease to recognize an asset and liability in the inception of the lease unless the lease is short term or the minimal. However, the IFRS did not change the accounting as treatment of the lease by the lessor. This is because the most stakeholder did not believe that the requirement related to IS-70s were broken. They perceived times and the cost involved in the implementing the substantial change to the lesser accounting as well as therefore believed to be the overweigh and the benefits. The financial statement and the reporting entity. The financial statement में क्या होता है? The financial statement or the financial the particular type of the reports. So the purpose of the financial statement to provide the information to the users about what? Asset, liability, equity, income and expenditure. The information is provided. The statement of financial position, statement that is called the balance sheet, financial performance that is called the income statement, and balance statement such as the cash flow and other notes. The financial statement prepare on the assumption that there is a going concern. This means it should be continued to operate for the foreseeable future, and if the assumption is not accurate, then the financial statement should be prepared on a different basis. अगर assumptions deviate, reporting entity is one or prepare the financial either through the choice as a result of legal requirement. The financial statement produced two or more entities that are not parent subsidiary is called the combined financial statements. This circumstance, it is difficult to determine the boundary of the reporting entity. Note that the conceptual does not stipulate how and when to prepare the combined, although the board may develop the standard and the issue for this. The financial statement produced for a reporting entity that comprise a parent company and the subsidiary called the consolidated financial statement. These financial statements show the parent and subsidiary as a single economic entity. The consolidated financial statement the important information for the investor in the parents because the investor economic returns are dependent on the distribution from the subsidiary to the parents. So then unconsolidated financial statement also provide the useful information for the investors in the parent company, for example, about the level of the distributable reserves, but not the substitute for the information provided in the consolidation. So though cannot be the substituted, the both serves the different purposes. The economic resources, the asset is the present, the economic resources controlled by the entity as a result of the past events. The economic column may be the economic liability and equity. The present obligation of the equity to transfer an economic resources is the result of past event, the residual interest in the business. So these are this. Then coming to the change in economic resources are claimed as a result of the financial performance. That is the income increase in assets or decrease in liability that result in increase in equity and the equity holders. Decrease in equity asset and increase in the liability or result in decrease in the equity excluding the distribution to the or changes in economic resources of the claim. The contributions from or distribution to equity holder, exchange of the assets and liability that not increase or decrease of the entity. The economic research rather than has the potential to produce the economic benefits. The right that has the potential to produce the. Now coming to the recognition and derecognition. The recognition means recognizing into the books. The items are only recognized in the financial if they meet the definitions of one of the element. However, not all items meeting these definitions are recognized. So elements are recognized if recognition provide the user and the useful financial information. For recognition must provide the relevant information, that is the most of the important item, relevant information and a faithful presentation of the asset liability resulting income and expenditure. Recognizing might not provide the relevant information if there is an uncertainty over the existence of the element. If there is a low probability of inflow and outflow of the economic resource. Example, An element that is not recognized. An example, the IS 37 provision, contingent liability, contingent asset, prohibits the recognition of contingent liability and contingency because it is not probable that resources will flow from the reporting to the reporting entity. Recognition of the element might not provide the faithful presentation if there is a very high degree of the measurement uncertainty. The judgment is required in deciding if recognizing an element is appropriate. So it's here the main important is the judgment. Judgment is required in deciding the recognitions of the. That's why the specific recognition criteria may vary from the IFRS standard to another. So in one IFRS may be provided, another may not. If any asset or liability is not recognized, disclosure may be required to ensure that the user fully understand the reporting entity's transaction and that the implications that there may have no future earning and future cash outflows have on future earnings and future they may have the implications, so बताना चाहिए so they can report. Understanding 1. Botel operates the publishing industry. Botel operates a publishing. The Botel brand is a highly expected. As a result, the Botel brand is a highly expected, and as a result, the book published by the Botel received extensive coverage online and in a national and international press. The brand is internally generated, and according to the 38 intangible asset, is not recognized as the Botel finance, not recognized in the Botel financial statement. Discuss the extent to which the accounting treatment of the Botel brand is inconsistent with the conceptual framework. So now, moving to the understanding the concept, first we will go to the answer. So, the brand is an economic benefit controlled by the Botel. It has the potential to bring the economic benefit because of the exposure that the Botel brand receives. Despite the meeting the definition of an element, the brand is not recognized in the financial. The conceptual framework provides that the element should be recognized if the recognition provides the relevant information or the faithful presentation of the asset or the liability. That is a high degree of the measurement uncertainty. If there is a high degree of measurement uncertainty, then recognition may not provide the faithful presentation. That is the key point we need to know here. If there is the high degree of measurement uncertainty, that then the recognitions may not provide the. So the cost of internally generated cannot be reliably measured, and the treatment is because of the cost of setting up. The treatment is because of the cost of setting up and developing the brand cannot be separated from the operating cost to the business, and the fair value of the brand is also very difficult to determine because of the brand are unique. So there is a two things. First, the concept is there is a high degree of uncertainty in valuation. First. Second, since it is internally generated, very difficult to allocate the cost from operating to the brand, and since it's rare and have no fair value, so it it would seem that the accounting treatment for the brand as per 38 intangible asset is inconsistent with the conceptual framework. So that is the reason they are not reporting.